and Roger Montgomery from rogermontgomery.com. If you've got any questions about shares, our phone lines are now open. Give us a call on 1300 30 34 35, or if you prefer, you can drop us an email at yourmoney@skynews.com.au. Welcome to the programme.
My view is, I think betting on short-term price action is insane completely. But let me say this: I think longer term, the reality is that the globe now has so much debt that we won't be able to actually pay it off in today's dollars ever. And if you look at the unfunded liabilities of the United States and include their total debt, it's something like 800% of GDP. The chances of them actually ever paying that off, considering that this year's US budget is going to be $1.39 trillion in excess of their tax revenue. So I think what we're going to see is additional stimulus. On top of that, I think they're going to have to inflate their way out of the debt. And if you have an inflationary monetary policy, whether it's QE3 or something else, then I think what you're going to see is rising commodity prices and rising stocks. In the short term, I put a list of what I think are semi-fundamental technical indicators that might suggest the market might be bottoming at some point. But I have to declare my hand. I am absolutely shocking and terrible at predicting where markets are going to go.
You seem like Jim Rogers.
I don't. Well, hey, Jim and I are probably the only ones who actually know that we don't know where the market's going to go. Some of the breadth indicators in the United States now, advanced decline indicators now reaching new highs. The yield curve steep, credit spreads very narrow. The London interbank offer rate, as many people follow, it's been steady for some time, and sentiment and a whole bunch of different indicators is extremely bearish. And I think while the news is grim, that tells me that retail investors probably won't participate in the early stages of a rally, which traditionally has always happened. I don't know when that's going to occur, but it strikes me that all of those things combined, and the fact that I'm finding more value in the market now, suggests to me that whether you don't load up and bet the farm today, but an averaging in process, somewhere around now for A1 businesses seems like a sensible thing to do.
Our first caller, we've got David from Queensland. Welcome to the program, David.
Hey, thanks, Chris, and thanks for taking my call. I've got a question about IRE market. I've been watching it. I own the stock, and I've been watching it lately, and it's swinging madly up and down. And I've been watching the sales, and it's being sold down heavily shorted a lot. And I'm just wondering, I've listened to a lot of panellists on your show over a long time telling me that IRE market is a good company, good business, and I'm just wondering why a good business would be targeted as for heavy short selling like that. And one other thing for Roger is, how do I get a copy of his book, please?
Okay. I didn't pay him for that question, by the way.
This looks like it's just testament. It's just moving in line with what the market's doing.
Yeah, it's interesting, the comments that Michael makes from a fundamental perspective. Back in 2007, when it reached those highs, its intrinsic value was significantly lower. And I've seen this with Woolworths, and there's a number of other companies where this actually happens, and the price gets way ahead of value. And if you believe what Benjamin Graham said, in the short run the market's a voting machine, but in the long run it's a weighing machine, then over time value has to catch up before the price can generate any sustainable advance. What's happened in 2007, when it was about these levels, was the intrinsic value was closer to about $2.60. Now what's happened, intrinsic value has gone up to about $6.60 to $7.12, and the price is still still a dollar or two above that. So I'm not inclined, despite the fact that I think fundamentally this is a sound business. In fact, I've got it ranked as it's an A1 business. So there's only 56 companies in Australia that I rank as A1, and Iris is one of them, but it's just a little bit too expensive. Now, in answer to the question about the book, and I'm delighted to answer that, there's a website you can go to. It's www.rogermontgomery.com. And you can order the book there. And I think at the moment there's an offer that I'm happy to sign the book for anyone who orders it at the moment. But this will be the last print run of the book.
Wonderful. All right, we're going to go to another caller. We've got Abe from Sydney. Welcome to the program, Abe.
Thanks, Chris, for taking my call. There have been two takeover targets recently. That's Sandown Resources, SDL, at 50 cents, and Eastern Star Gas at about 90 cents. Now, I'm in at about 90 cents and 50 cents, exactly what the offer is. Would you get out, would you sell it, or would you hold on for an increase or better price?
Yeah, that's an excellent question there, Abe.
Unfortunately, can't add much value simply because I play a game where companies need to meet my criteria, and if they don't, I simply don't invest in them. Both of these companies have obviously done well in terms of their share price recently, but neither of them, as far as I'm aware, are forecast to make any money in the next 3 years. So unfortunately,
Sunrise is producing in 2014. So
yeah, okay, well, so 4 years. Or 3 years, but I don't have a valuation based on those numbers that's positive.
Yeah.
So at the moment, unfortunately, you know, the investors who are participating in this stock, they're smarter than me.